Picture this. You're sitting in the break room, and your coworker, let's call him Marcus, will not shut up about the massive gain he just made on a meme coin with a dog on it. Listening to him scroll through his phone and talk about buying a boat, your reliable, automatic 401k contributions suddenly feel incredibly stupid. You start wondering if you are the only one missing out. But what Marcus is conveniently leaving out is the 3 other coins in his wallet that just collapsed completely down to zero. He is also skipping over the fact that he's waking up in a cold sweat at 3 a.m. just to check his portfolio. When Marcus repeats these talking points in the break room, he is acting as the final, unpaid spokesperson for a multi-billion-dollar marketing machine. The industry relies on these social interactions to turn your patience into FOMO, recruiting new retail capital through the peer pressure of getting rich quick. To see how the casino really operates, we have to look at the global data. The Bank for International Settlements tracked retail crypto trading across 95 countries to figure out who is actually profiting. This data visualization shows a harsh reality. Between 73 and 81% of retail investors globally lose money trading crypto. The average loss is 48%. You put in $5,000 and walk away with $2,600. These statistics describe a systematic transfer of wealth from the pockets of everyday working people to institutional players. The math is rigged against the individual trader from the start. Let's go back to Marcus. Like millions of others, he jumped into the crypto market right at the peak of the hype cycle in November of 2021. He made this decision surrounded by major marketing campaigns, blanketing events like the Super Bowl, featuring celebrities telling him that fortune favors the brave. This chart shows what happened next. He took $8,000, money supposed to be his house down payment, and threw it into the market. After a year of panic, he sold at the bottom for under $2,000. But if he had put that same money into a standard S&P 500 index fund instead, it would have grown steadily to over $11,000 today. The cost of chasing that hype has devastating real-world consequences. Marcus wiped out his savings and lost the home he was trying to buy for his family. The people who actually build generational wealth have replaced the dopamine hit of trading with a strategy that feels exactly like watching paint dry. Their ultimate weapon against the casino is the target date retirement fund. It is an unsexy, hands-off strategy, but it works because its core mechanic removes the single biggest threat to your wealth, your own emotions. This chart illustrates a Morningstar study measuring the exact cost of human error. Active traders in complex funds bled 1.2 percentage points a year trying to time the market. But hands-off investors in target date funds left only 0.4 points on the table. They achieved this on autopilot. As you get older, the fund automatically shifts your money from aggressive stocks into conservative bonds. This invisible automation forces you to buy low and sell high. You never have to read a financial headline, stare at a chart, or try to guess the market bottom at 2 a.m. Over the long haul, the broader market has returned an average of about 10% annually, proving its resilience through the worst disasters in modern history. It absorbed the economic devastation of the Great Depression, it recovered from the toll of multiple world wars, and it has rebounded from every major financial crisis the modern world has thrown at it. If you invest $500 a month into a target date fund starting at age 25, you let compound interest do the heavy lifting. By age 65, your $240,000 in contributions will grow exponentially to over $3 million. While Marcus bleeds up to 30% of his capital paying massive transaction fees to swap meme coins, you are paying a tiny fraction of a percent to own a piece of the most successful companies on earth. The financial industry wants you to believe that investing requires constant attention, that complexity keeps you trading, and your constant activity is exactly how they generate their fees. So here's your explicit homework for today. Log into your 401k or IRA. Make sure your money is allocated to a target date fund, and set up your automatic contributions to capture every dollar of your employer match. Then, physically delete every single day trading or crypto app off your phone. Put some necessary friction between your daily impulses and your bank account. It is time to stop performing wealth and start actually building it.